Okay, if you want to understand where the Manhattan investment sales market is heading to, you would have to zoom out and look at the data over decades, not just months. For more than 40 years, Bob and his team, we have tracked every single investment property sale out of 96 and over 27,000 buildings. And here's a key stat. On average, only about 2.5% of properties trade each year. That means that owners hold their property roughly 40 years. So when transaction volume drops even just a little bit, it's not noise, it's a signal. Historically, turnover moves into cycles. Every time unemployment spikes, like in 1992, 2003, 2009, on 2020, transaction activity drops sharply. And why? Because capital pulls back, lenders tighten, and investors hit pause. But here's the pattern. Once instability returns, the market doesn't just recover, it accelerates, and there's the opportunity. Now, layer in property taxes and major changes have consistently triggered as owners rush to transact before new rules take over or take go on effect. Some of the biggest transactions ever come right after or before these shifts. But this cycle is different. Since 2019, regulatory changes, especially around rent stabilized housing, have effectively frozen a large amount of like the portfolio in the market. We're in the longest stretch of below average sales activity in over 4 decades. And here's the opportunity. History shows that this slowdown don't last forever. And when financial pressures builds through loan restructuring, note sales, or distressed transactions, the market tends to unlock very fast. And when it does, transaction volume can surge dramatically. So the big question isn't if the market will move, it is when. And if the past is any guide, the next cycle could be one of the most active we've ever seen in decades. So if you're an owner or an investor, now it is the time to start watching these signals very closely because the shift might already be happening right now or might be underway. Thank you.